Next thing I want to touch on are the different income types. Kind of break those down for us. Okay, so there are a few different types of income that are relevant for loan approval process. You have W-2 income, which can come from your regular general employee-employer relationship. You can also get W-2 income from an S corporation because you are an employee of your S corporation. There's also K-1 income, which can come from the S corporation as well as partnership multi-member LLC. And then in the partnership multi-member LLC, you would not have a W-2. So you have Schedule C income, which is what in the tax world we call self-employed income. Then you have business return income, which is going to be W-2 K-1 for an S Corp owner. And then you just have K-1 for a multi-member LLC or partnership return. Okay. Why would you set up one over another? The S corporation has tax advantages only at certain income levels, although that's not the only metric that we look at when we're seeing if the S corporation makes sense. But the S corporation is considered a tax advantaged status because you're not paying self-employment tax on your net income like you are in the other business entities. So you do have to pay 15.3% of Social Security Medicare on your W-2 wages, which is the equivalent of self-employment tax, but you're only paying it on the W-2 wages, not the net business income, which is what's reported on K-1. We get this often where someone has an S Corp, they W-2 themselves, and then they have the business income. So you're saying that that has a tax advantage because they're paying less on the S Corp income? Yes. Okay, cool. And now let me touch on that because I ran into this question yesterday where they didn't understand why can't we just use a W-2? Why do we still need the business return? So from a lending perspective, we have to make sure the business is still running in the green basically, because what if you made, $100,000 that year and you W-2'd yourself 120 and you took a $20,000 business loss? We now have to count that business loss against you, even though you W-2'd yourself this amount. You are still the owner of the business. That is still your debt that's coming off. So we still have to show those returns. So yes, it's great that you W-2'd yourself for the tax purposes. I still have to count you as self-employed income because you are still self-employed income. And then let's touch on that really quick too, kind of the difference between W-2 and a normal job, like you said, employer-employee versus W-2 and an S Corp. Again, W-2 and S Corp, that is your company, that is your business. So we're still looking at the whole picture, not just that W-2. So don't try to trick the system and take a business loss because you thought you were safe paying yourself a W-2. We still have to count that against you. And then, a typical W-2 is if you work for a grocery store and they pay you, a salary or an hourly wage, that's a W-2. And then obviously their income that we have to look at unless you report other income, but we would just go off of that. So that's the big kind of difference there. The next one that you had touched on was the K-1 piece of it. So explain to me the difference of a K-1 and where that ties into an S Corp. So when we do an S Corp return, there's no income tax paid on an S Corp level. So the S Corp return and the partnership return are just informational, basically, where it's income and expenses that result in net business income. There are obviously other things that are reported on it, but for all intents and purposes, that's what's reported on those returns. That net taxable business income is reported on the K-1 for that income to flow through to the individual taxpayer. Because you're not paying income tax on a business level, you're actually paying tax on an individual level on all that pass-through business entity income. So the K-1 is analogous to a W-2, and that box 1 is this, box 2 is this, box 3 is this. The K-1 is what simplifies that reporting and the flow through of that income from the business to the individual return. So that's another really interesting thing outside of the lending approval process. But with business ownership and business taxation, if you owned an S Corp and I owned an S Corp, let's say that you're married with kids, you have all these deductions on your return, you make $200,000 in your S Corp, I make $200,000 in mine. I'm single, no deductions, no kids on my return. We're actually going to pay different tax rates on that same $200,000 of income because it's taxed on an individual level, even though it was generated from two S corporations.
Interesting.